Hey, what's going on, YouTube family? So this is Paul Paquin, CEO at Golden Financial Services. And this is right now I'm talking to you in a post-COVID-19 environment. Credit card companies are about to resume monthly payments if they haven't already. And a lot of people are going to be in a position where they don't know what to do. Are you going to continue paying minimum payments? What's the plan? So we're going to help you out with figuring out the best way to get out of credit card debt. And we're going to share with you not one, but 10 of the best ways to deal with high credit card debt in a post-COVID-19 environment. So without further ado, let's jump in and let's get started here. I'm going to share my screen with you guys. Okay, here we go. And number one. Bam, number one. Debt snowball method is number one. Oh, and if you guys want to find this same infographic, go to goldenfs.org. Go to the menu. Go to debt relief options. Go to credit card relief. And you're going to find 10 best ways to clear credit cards. Hit that. Here we are. All right, number one, debt snowball method. This method was created by Dave Ramsey. It's when you pay your minimum payments on everything besides the account with the smallest balance. Now, the smallest debt is what we're going to aggressively attack while paying minimum payments on the rest. By putting all of your extra money towards paying it off, you're going to get it paid off fast. And by getting it paid off fast, you're going to see results quickly. So the point of the debt snowball method is to see fast results, and that's going to motivate you to get more of the same type of results. Your brain, dopamine, is going to be released in your brain, and it's like an adrenaline rush when you see results and pay off your smallest debt. Oh, great, I succeeded. Let's pay off the next one. So the point of this is fast results. That's why we go after the smallest debt first. And the reason it's called the debt snowball method is because when you roll a snowball, it gets bigger and bigger as you roll it. The momentum makes it easier to accumulate. Well, with the debt snowball method, each time you pay off debt, your snowball of cash is what's accumulating, getting bigger and bigger. So as you pay off the cash, the extra cash, as you pay off that first debt, right? You now have less credit cards that you have to pay. So you're going to have more available cash flow. And you're going to keep funneling that extra money towards paying off the next debt in line. So the next smallest debt in line. And one by one, you're going to get all your debts paid off until you're debt free. The momentum will just keep carrying you through the process. The other option that is, now both of these, number one and number two, the debt snowball, the debt avalanche method, these options are going to improve your credit score because each time you pay off a credit card debt, you are improving your credit utilization ratio. On that point, make sure you never close a credit card out. That's the worst thing you can do. You want to keep the credit card open so it shows you have all that available credit. And that available credit, the more available credit you have, the better your credit utilization ratio is. The more credit you use, the more debt you have, and that hurts your credit score. So by paying your balance down, you get more credit and your credit utilization ratio improves, and that improves your credit score. The number two option, the second best option, which improves your credit and saves you money, is the debt avalanche method. This option, instead of paying off your smallest balance first, you would pay off the credit card balance with the highest interest rate first because it's the one costing you the most money. So you can actually save more money with the debt avalanche than the debt snowball. But the problem can be that the one with the highest interest rate can also have the highest balance. So you can have maybe a 28% interest rate and the balance is $10,000. So you're going to pay off that one first. It could take you over a year. It could take you 2-3 years to pay off that first debt because it happens to be the one that has the highest balance. So people get frustrated. They're not seeing fast enough results and they quit. So as long as you can anticipate, hey, this is the highest balance, it's going to take me, at least a year to pay it off, you can save the most money going this route because you are eliminating the debt that is costing you the most money first. This is the debt avalanche method. You can use a combination of the debt snowball and avalanche method. You can pay off all your balances that are around 1,000 or less using the debt snowball method. So you're going to attack the small step first. And then once you get all your small ones paid off, you're going to have that adrenaline, that good feeling. Oh, I'm succeeding. I paid off 3-4 debts, whatever it is. And then switch over to prioritizing the debts by the interest rate. The one that has the highest interest rate, get rid of that next. And that's a really strategic option. So the debt avalanche, debt snowball, great options. Next, you're looking at pay off your credit card debt with a balance transfer card. Credit card companies charge you an upfront fee when it comes to a balance transfer card. And when you can't pay off your entire balance within the introduction rate period, which is usually 12 to 18 months, the interest rate gets jacked up. So they may offer you a 3% interest rate for 18 months. But then after 18 months, if you don't have the entire balance paid, the interest rate shoots up to 25%. So be careful. There's what the banks call, it's a balance transfer trap. So this is a trap. The banks are betting on you not being able to pay off the balance in full within that introduction rate period. Make sure you can do it, okay? And then the other thing is, you will need a high credit score to get a low interest balance transfer card. So I wouldn't even think about a balance transfer card as a way to pay off credit card debt unless your credit score is at least 700 or more, 700 or higher. When is a balance transfer card worth it? If you can pay the balance in full within the 12 to 18 month introduction period, you could end up paying low to no interest and only the upfront fee. Now, the fee, if it's a $100,000 balance transfer card, the fee is going to be up to $5,000. The fee is 3 to 5% of the amount of debt you are transferring to the balance transfer card. First off, to get a $100,000 balance transfer card, you're going to have superb credit, 730 or higher FICO score. So yeah, just keep that in mind. You will have to pay 3 to 5% of the amount you're transferring to the card. And you got to make sure when you do the math, right? You always want to do the math. Look at what you're paying now. You can use a debt calculator to do so. And then compare that to what you'll pay with the balance transfer card. Make sure to add the interest rate in. Make sure to add the upfront fee in and do the math. It's got to make sense. Home equity line of credit. You will get the lowest interest rate with a home equity line of credit. This is the wonderful thing about a home equity line of credit. You can use it to pay off your credit card debt. Just because it's a home equity line of credit doesn't mean that you have to use it for your home. Now, here's the danger. If you don't pay your credit card debt, yeah, you're going to have bad credit, but at least you have options to resolve it. However, once you transfer that credit card debt to a secured home equity line of credit, this is a secured debt, your house is going to be the collateral. So let's say you get this home equity line of credit 2 years down the road, you transfer all your credit card debt onto the home equity line of credit, and then 2 years down the road, you lose your job and you can't pay the home equity line of credit. You're in big trouble. You could lose your home and all of your credit card debt. So be very careful with this option. It can be very dangerous. Negotiate with the bank to reduce the interest rate. Try negotiating directly with your creditor to reduce the interest rate and monthly payment. In many cases, all it takes is a simple phone call. You show them how loyal you've been. Make sure you speak with a supervisor, because only a supervisor is going to have the authority to make these changes. Here's the script. You can get the script right here on this infographic. But basically, you're going to let them know how many years you've been with them. You're going to remind them you've always paid your bills on time. They're going to look at your history. So you're going to ask them, based on my history with you, I am asking you to lower the payment or lower the interest rate. Now, what you're going to do here is you're going to bring up another bank. You're going to let them know, for example, Capital One is offering me an interest rate of only 3%, and they're also giving me cash back if I switch over to a Capital One credit card. So you can let them know, I'm going to transfer my balance over to this Capital One credit card, and I'm going to close my credit card with you. I don't want to though, because we've been together for so long. So I'm asking, can you please work with me on this? You're just going to use the other credit card as leverage, letting them know you've got this offer, and you're asking them to match it. So that's a great scenario. If you can get them, if you can call the bank, ask to speak with a supervisor and get them to lower that interest rate or lower the payment, that's a great scenario. The next option, just make sure you never want to accept any type of credit card deferral, because if they're going to defer the interest rate to the back of your credit card debt, that's going to increase your debt. So a lot of times the bank is like, yeah, we'll defer the next 6 payments, but it's not going to be interest free. So they're capitalizing the interest to the back of the debt. You're increasing your debt. You're going to have to pay all that back eventually. So how on earth is that helping you? It's not. So anytime the bank offers you anything, just make sure that it's interest free. If it's skipping payments, make sure it's interest free. And that's important. Now, banks have their own credit card hardship program. Maybe they will have an option where they can lower your payment for a year, or sometimes the interest rate, they can lower the interest rate, but a lot of times they will lower your payment for up to a year, but they will only approve you if you are behind on your monthly payments. But you don't want to fall behind just to do the bank hardship program because you don't want to hurt your credit score. Here's the trick: 7 to 10 days. So you only fall behind for 7 to 10 days, then you call the bank. They see you're behind by 7 to 10 days, but it doesn't hit your credit that quick. So as long as you only fall behind for 7 to 10 days, it won't hit your credit. And then you call, you show them that you're behind, make sure you fax over some type of hardship letter detailing the situation that you're dealing with, detailing your hardship situation. Include a copy of your budget showing that you can no longer afford the payment. So it's basically, here's proof. And that's going to increase the chances of them putting you on their own internal hardship program where they lower the payment for a year. Just make sure, as always, that you don't want to get any type of interest capitalized at the back of the debt. I can't say that enough. Next, we're looking at programs available. So these are hardship programs where you can no longer pay your debt. Number 7, we're starting with debt validation because it's the least expensive, and debt validation potentially as a byproduct of debt validation, the debt could potentially come off your credit, the late marks and the debt entirely can come off your credit. So debt validation is similar if you get a speeding ticket, right? And if you get a speeding ticket, the police officer says you were going 80, but you know you were going the speed limit. Are you going to pay the ticket and then your insurance goes up? Or are you going to hire an attorney to fight it and potentially get it dismissed? Well, of course, you're going to fight the debt. You're going to hire the attorney, or you're going to dispute the ticket. Maybe you won't even need an attorney if you truly weren't speeding. They're saying you were going 80 and you know you were going 60. All you need to do is go to court and tell the judge that you weren't speeding. The judge is going to request proof from the police officer to show that what they claim you were doing is accurate, and they won't be able to provide that proof. So the speeding ticket gets dismissed. Similarly, with debt, there are 14 federal laws that regulate between the original creditor, like the Credit Card Act, and then between the third-party debt collection company, like the Fair Debt Collection Practices Act. And then there are laws that regulate your credit report, like the Fair Credit Reporting Act. So all of these laws are incorporated into what's called a debt validation program, where the debt is disputed, similar to how you would dispute a speeding ticket. Okay. And now the debt collection company has to prove that what they claim you owe is accurate. And by the time your debt ends up with a third-party collection agency, there are fees that you never agreed to that get tacked on. So in many cases, they can't prove that what they claim you owe is accurate. They're wanting to get more money than what you legally owe. Or if they violate federal laws, I'm just giving you a few examples there, like the Fair Debt Collection Practices Act, like maybe they're trying to collect on debt in Alaska, but they don't have a debt collector license in the state of Alaska. So they can't produce their debt collector license. They can't show that they are licensed to collect debt in your state. Or maybe they can't produce the original agreement that you signed when you first got that credit card that has your signature on it. They can't produce it legally. They are required to maintain certain documentation in their records. They're required to have certain information, and it needs to be accurate, like information such as when you first were late on the account, when the statute of limitations expires, if they can't produce accurate information, all of this can result in the debt becoming legally uncollectible, invalidated, where you no longer have to pay it, and it can no longer legally remain on your credit report at that point. So, yeah, if you want to learn more about debt validation, you can actually go right on Google. You can type in debt validation. Whoops, let me spell it right here. Debt validation program. And we are #1 for that. So you will see us right here, debt validation program, how to fight a debt and win. So real quick, you can watch this video, which is a great little summary of it, but real quick. So here's, after the debt is disputed, the collection agency will have to either prove the debt or they will send a letter that basically says, like this letter right here, based on your stated dispute, we have ceased collection, stopped collection on the account. That means, in addition, we have requested the consumer credit reporting agencies delete the account from your credit. So that right there, this is a defensible record proving the debt to be invalid. This letter right here is a key fundamental to the rest of the debt validation program. But if you want to learn more about it, go on, you can search on Google and go to that debt validation program page. Debt validation is less expensive than debt settlement in the end because you're not paying the debt, you're just paying the cost of the program, and potentially it can get the debt off your credit, which is key. Debt settlement. Debt settlement is a last case scenario. And the reason why is because there are downsides. For example, with debt settlement, you have to stop paying on the account. The account will eventually go to collection, but one account at a time is settled. So when you do a debt settlement program, only one account at a time is being dealt with. So that means some of your creditors could sit for 2 years without even being touched. And that's a downside. That puts more risk for a summons, for a lawsuit to occur. And yeah, so if you do debt settlement, you want to make sure the debt relief company helping you has multiple programs. You want to make sure they do debt validation as a first approach, because you really only want to settle the debt if it's validated and it's proven to be valid, then you could settle it. But there are downsides with debt settlement programs. Credit scores will, of course, go down because you're not paying the debt, but you end up with late marks and collection marks. The only time you would want to do a settlement where it's actually attractive, you can do this on your own, is if, first off, the bank will write the debt off. They will get reimbursed through tax credits by showing a loss, and they have banking insurance, and then they sell the debt for 10 or 20 cents on the dollar. So the collection agency is going to willingly settle it. They will offer you a settlement sometimes without even doing a debt settlement program. They're going to work directly with you. They may offer to settle the debt at 40%. So a $100,000 debt, they may offer to settle $40,000, but you still will have the collection account on your credit. So the only way you ever should accept a settlement is if they are willing to remove the debt and the late marks in the collection account from your credit entirely. That needs to be part of the deal. I would rather pay $50,000 on $100,000 debt in exchange for removal of the debt and the late marks from my credit. I would rather pay $50,000 instead of $40,000, where the $40,000 route, they're only going to report it paid or paid in full. We don't want it to show up a collection account paid in full on your credit. We want it removed because the collection account is killing your credit. So you need to get that off. I'd rather pay more money on a settlement in exchange for having it removed. Now, consumer credit counseling, we put this at number 9 because it costs more. You're going to pay more than with debt settlement or validation, but the benefit is that you stay current. If you have credit cards, you can even be behind by a month or 2, and credit counseling could negotiate with your creditors to reduce the interest rate and get your late payments to be re-aged to show that you are current on your monthly payments. Now, this program, the benefit is the reduced interest rate. So you could have 30% interest rate get reduced to 10%. Now, instead of taking 8 years on your own paying minimum payments to become debt-free, you can pay off all your credit card debt in 4.5 years at the same payment. Your payment will be about the same as when paying minimum monthly payments on your own. Payments will stay the same. The difference is you save money at interest rates, so you get out of debt under 5 years. 4.5 years to 5 years is how long it takes. You will have your credit cards closed. Never close your credit card. By closing your credit cards out, you reduce your credit utilization ratio, and that hurts your credit score. So that is a downside. The consumer credit counseling companies don't always explain that, but you will have your credit score go down by closing out your credit cards, and you're locked to this payment plan. So consumer credit counseling programs are good for those of you that just do not want to fall behind on your credit card bills, and you will do anything to stay current. This could be the option to help you out. It could get your payment a little bit lower than minimum payments, but it's going to stay close to the minimum payment amount. That's it. So if you have a 750 credit score and have never had a late mark on your credit, your goal may be to preserve your credit score, and this may be the best way. Again, it will go down a little bit, but not a lot. You could keep it above 700. If it's 750, your score may go down to 700. I mean, that can vary, but I'm just saying it's not going to go down to 600 because you're staying current. So you're preserving much of your credit score. The last option is bankruptcy. Why did bankruptcy even make this list? Best way to pay off credit card debt, bankruptcy, huh? Well, here's why. Okay, because the fastest way to pay off credit card debt, well, this post is not the fastest way to pay off credit card debt. Okay, the name of this post, let's go back up, fastest ways to clear credit card debt. And bankruptcy is certainly one of the fastest ways to clear credit card debt. And that's why it's on this list. Bankruptcy, Chapter 7 only lasts for 3 to 6 months, making this one of the fastest ways to escape credit card debt. You can get rid of credit card lawsuits. And here's a list of the debts that do not qualify, including federal student loans, tax claims, child support. So yeah, you can check this list out more if you'd like to see this post. Just again, go to the goldenfs.org homepage, click on the menu, go to credit card relief, and then you will see the 10 best ways. So the downside of bankruptcy, well, this list is, it could be a lot bigger than this, but in summary, your credit score is going to get hit hard. It can get lowered by up to 175 points. You're going to have bankruptcy. It's going to say debt discharge due to bankruptcy on your credit. This can be a 7 to 10 year negative effect. Potential employers, landlords, and creditors will be able to see you file for bankruptcy. It's going to prevent you from getting low interest loans in the future. You may not even be able to get a car loan, or if you do, it's going to be with a high interest rate. And you just don't want this negativity attached to your name if you can avoid it. Everything from premiums on car insurance, cell phone, and monthly insurance payments can all legally increase once bankruptcy is on your credit. Here's the thing though, if you're going to lose your home, Chapter 13 bankruptcy can save your home. If you have 5 credit card lawsuits, and these things, if you have a lot of credit card lawsuits, this can be hard to deal with, even with a debt settlement program. So bankruptcy can deal with these lawsuits quickly. So there are times when people need bankruptcy, but it's rare. Very rarely do people need to file bankruptcy. If you want to learn more about Golden Financial Services, I recommend go to goldenfs.org. I did not want this to be a promotional post, but if you need a program, you can go and you can see the options in your state, or you can go and you can choose an option. There's a couple different options, as you know, which we just went over. You can compare getting a loan, debt validation, student loan consolidation. There are different options available. If you have any questions, submit it in the comments. Please like and share this video, and we will definitely do more videos in the future. So I hope you enjoyed it. Thank you and have a great day.